Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel. If you enjoyed today's video, hit like, hit subscribe, and that way you can see future videos as well. So in this video, we're going to talk about a company that is arguably one of the greatest investments, I think, frankly, of all time. Over about a 70-year period, it turned every dollar invested in that company into about $70,000. Benjamin Graham actually talks about putting 25% of his fund into this particular company in his book, The Intelligent Investor. Warren Buffett put about 50% of his net worth into this in the 1950s himself. And then Warren Buffett again also actually purchased the company outright through Berkshire Hathaway in 1995. So it's an incredible growth story. It's been an absolutely phenomenal investment, and it's got a few kind of key characteristics that I want to talk through, which really allowed it to achieve super high levels of growth over a long period of time. Now, before we get into that, we do have a sponsor for today's video, and today's sponsor is Hatch, who, by the way, have sent me this really nice hoodie, which feels great. Got the Hatch logo up here, the Hatch purple. It's also actually got my customer number on here, number 2731. I think there's about 60,000 or so customers on Hatch now, so it's pretty early on there, which is quite cool as well. So Hatch are the sponsor for today's video, and if you're not familiar with them already, they are my broker of choice for me as a New Zealander investing in the US and buying all my US shares. As you can probably tell by my fairly low customer number, I've been working with Hatch for quite a while now, and they've been my personal broker for quite some time. I initially switched across purely because of fees, to be perfectly honest. I was paying $90 a trade at a big bank to buy US shares, having to do that over the phone, and now I can do that in Hatch, easily online, super modern platform, and I can do that same trade for $3. So massive money saver on brokerage. I also actually save a lot of money through Hatch through foreign exchange as well, which a lot of people don't talk about with the big banks. They certainly clip the ticket quite a lot on the way through when you're trying to transfer your New Zealand dollars into US dollars, and Hatch has really attractive foreign exchange in my experience as well. So that's been fantastic. I really like the company, and if you're interested in getting started with Hatch yourself, you'll need to go to the link hatch.as/investingwithtom. If you go to that link, start a new Hatch account and deposit 100 New Zealand dollars into that account, you'll get a free $20 top up so that you can get started investing with a little bit more cash. Okay, so if you haven't already guessed this company, it is Government Employees Insurance Co., or GEICO for short, as many of you probably know it. It's an insurance company. It's currently a subsidiary of Berkshire Hathaway, and it's got a very long and successful history in the sort of value investing world as well. If you read the postscript to The Intelligent Investor, you hear Ben Graham actually talk about this business. It mentions that in 1948, Ben Graham and his partner Jerome Newman put around 25% of their fund into GEICO, which at the time was enough for them to buy a 50% stake in the GEICO business, and that cost them $712,500. Now, if we fast forward several decades to about 1995, Warren Buffett actually had a 50% shareholding, or about 51% to be exact, in GEICO in about 1995, and he bought the remaining 49%, so near enough to the same stake that Ben Graham bought back in the 40s, and that cost him a massive $2.3 billion. So that means that from 1948 through to 1995, GEICO returned a compounded annual growth rate of about 18.7% per year. Just making that one decision in 1948 and holding on to it made you almost 20% a year for decades and decades and decades. And it didn't actually stop there. Now, if you look through some of the financial statements for Berkshire Hathaway, where GEICO now sits, you can actually see that GEICO, if you value it on a similar sort of earnings multiple to what Buffett paid back in the 90s, GEICO is probably worth about $50 billion today. Compare that to the purchase price in 1995 of about $2.3 billion, which is more like $4.6 billion, because the 2.3 was only for half of GEICO, so let's call it a valuation of $4.6 billion. That is now worth probably about $50 billion, so even since 1995, when Buffett bought the entire GEICO business outright, it's probably been about a 10x in intrinsic value since that point, even after it did the 18 or 19% a year for decades. So if you ever needed a lesson in why not to sell a wonderful business if you can get it at an attractive price, GEICO is it, and I want to talk through some of the characteristics that GEICO had way back in the 50s when Ben Graham and a young Warren Buffett were getting invested in GEICO for the first time, and talk through how those characteristics allowed GEICO to be so successful for years and years and years, and also talk through one point where GEICO actually did stumble and Buffett was actually able to buy an even larger stake in GEICO in around the 1970s. Now, for those that aren't familiar with the GEICO business, GEICO is a US auto insurer. They were founded in the 1930s, and they've grown to become one of the largest names in auto insurance right through that entire period, to where they still have kind of a market-leading position here in 2020. So how on earth does this little insurance company that gets started in the 1930s become so successful? Well, I'm going to read you a few bullet points from a Warren Buffett article that Buffett actually wrote in 1951, and I'm going to put a link to that article below because you can actually still get a copy of it, and you see a young, fresh-looking Warren Buffett face kind of on that article. But this is kind of some of the things that Buffett said in that 1950s original article, and the amazing thing is that a lot of these drivers of the GEICO business still hold true today. So basically, Buffett said that GEICO is a low-cost provider of insurance, of auto insurance. At the time, they didn't have any agents, they didn't have any branch offices, and it allowed them to undercut the competition by about 30% in terms of their insurance premiums that the customers had to pay. Now, 30% is really attractive when you're in rural areas and people are paying for auto insurance and they're looking to save a little bit of money, but it actually becomes even more powerful when you go through things like recessions, when GEICO eventually expanded to larger cities where auto insurance tends to be more expensive in general. A 30% saving became kind of a larger dollar amount in those sorts of situations. And at the time in the 1950s, GEICO was only present in about 15 of the 50 states of America at that time. And they were yet to get into some of these larger, kind of more expensive states. So they had this extremely long runway for growth, and they had this massive long-term competitive advantage of being the low-cost provider of insurance. So GEICO had a moat, it still has a moat, it had a massively long runway for growth and just a core kind of advantage that was not going to go away and that was always just going to slowly pull more and more people towards GEICO, assuming that they could keep that low cost advantage going. But that wasn't the only characteristic of GEICO at that time. They also had phenomenal management. They still had the founders in place in the 1950s, and it wasn't until the founders passed away in the early 1970s where GEICO did actually stumble a little bit. And as well as the founders running the business in the 1950s, you also had the famous Benjamin Graham, the Dean of Value Investing, as actually the chair of the board at that time. He personally had put 25% of his fund into it, so he was kind of at the helm, making sure that everything was going well with that particular investment. And interestingly enough, Ben Graham is the Dean of Value Investing. He's kind of founded a lot of these concepts that we still all invest on today. And he spent an entire career in the investment field and managing other people's money. Now, a really interesting fact is that he made more money for his investors off that one GEICO investment than all of his other investments through his entire career combined. So you've got these massive tailwinds from being a low-cost provider. You've got a long runway because you've got a relatively small market share here in the 1950s, and you've got great management. And all of those things really combine to help GEICO grow an extended period of time. And I should also say that one of the things that I should have written down here, but I didn't, was that GEICO also had extreme focus. They have always been focused on the auto industry, even right back in the 1950s here when Ben Graham and Warren Buffett were first getting involved. And they've had a very strong core focus on that field specifically. They haven't expanded into other fields of business or even other fields of insurance really, and it's allowed them to stay focused on being the absolute best they can possibly be at this one thing, which again has driven their growth over the very long term. Okay, so let's talk about the stumble that GEICO did actually have. Now, in the 1970s, the founders had recently passed away, kind of early 1970s we're talking here, and for a long time GEICO had been expanding at very, very fast rates. And basically they'd just gotten to a point where they had expanded too fast and they hadn't kept some of the back-end kind of loss reserves and things like that sufficient to keep up with that growth. Now, if you're not familiar with what loss reserves are, basically they are a liability that an insurance company has in order to protect them and have money available to quickly pay out for any claims that might come through. And basically, as GEICO expanded their insurance business, generally you'd expect that this loss reserve also grows at about the same rate. You know, as you have more customers where you have more potential claims that might come through for auto insurance, you have more money sitting there to be able to pay on those insurance claims when they come through. But unfortunately, GEICO did not maintain that larger loss reserve that they needed, and it meant that they did stumble. But the business had such strong competitive advantages that it did survive. Warren Buffett took that again as an opportunity to buy an even larger stake in GEICO at that time, and the business eventually did prevail and come out the other side and kind of get back on track and continue its upward trajectory. So that is kind of a quick story on GEICO, and there are a few lessons for me kind of in that story with that particular business. The first one is, if you ever get a chance to buy into a great business at a good price that has these long runways for growth, unless you find something else that is extremely attractive and you really don't have any other cash to put towards it, it's probably best not to sell that particular business. You know, Warren Buffett put half of his net worth into GEICO when he was 20 years old. He sold out of GEICO here and there. He bought back in a little bit more in the 70s. And it was a mistake in his mind not to just continue to put more money into GEICO over an extended period of time. He eventually had to rectify that mistake in 1995 by paying $2.3 billion to accumulate the other, remaining 49% of GEICO, where, Ben Graham was paying less than $1 million for that in 1948. So hold on to great businesses, and in order for a business to be great, it has to have some sort of sustainable competitive advantage. I know we talk about this all the time on the channel, but it is such an important point for a business to have. If you are an insurance provider like GEICO and you don't have, that low cost provider kind of option, then you're just not going to be as successful as you would have been otherwise. If you can charge 30% less than all your competitors, that is a huge driving force to continue to grow the business and kind of pull customers in. The other lesson I get from this GEICO story is that you must have a long runway for growth as well. Even if you do have a great competitive advantage, it's probably not going to help you all that much if you're working in some sort of small niche industry or you've already got a huge market share. But GEICO was coming into a massive industry and a growing industry through auto insurance, and they had a competitive advantage that wasn't going to go away, and it meant that they literally had decades and decades and decades and decades of runway to continue to grow at really high rates. And a final couple of lessons for me is, firstly, you have to have good management in place. Even if you have the best business in the world, which you could make a very strong argument that GEICO might just well have been over the past, 70 years, one of the best businesses in the world. Even if you have one of those great businesses, if you don't have the right people at the helm making prudent decisions, it can stumble like it did in the 1970s. And the final lesson for me is that an investment career and an investment lifetime can be made by one decision, and that's exactly what we saw with Ben Graham. He used to teach investing for a living, and he managed money for literally decades, and it was just this one decision which changed everything for his investment track record. So that's it from me today. I do hope you enjoyed the video. For me, it is a fantastic lesson on how long-term investing is the absolute way to go. So I do hope you enjoyed it. If you did, please hit like and hit subscribe. If you're interested in the Hatch offer, again, the link will be up on the screen here, hatch.as/investingwithtom. Go to that link and get your free $20 if you haven't already. But that's all from me today, and I will see you in the next one. Cheers.